name's Amy Garner. I'm the Chief Compliance Officer here for the system. But something that you may not know about me is that in a former life, before I was your Chief Compliance Officer, I actually used to be an accountant. In fact, some of our accountants back there know that I was an accountant, but probably not a very good one. So I'm no longer doing that, thank God. I used to do taxes too, and I actually love taxes. I know that sounds really crazy, but I do love it, and I still do them a little bit on the side, but I am definitely not a tax expert. So today I have invited the man that I think is the tax expert, Jack Matthis, who's a partner with ATA in Milan. I have asked Jack to come and give you some advice on how to maximize your deductions because it is tax season. Jack, it was up at 3 o'clock this morning working on taxes, so we're right in the throes of it. So you've only got a couple months to get those filed. So Jack is going to give you some great tips today. And remember to fill out your evaluation before you leave today. Thank you.
Thank you, Amy. Amy knows that I was up at 3 a.m. because I emailed her at 4, and I told her she's just lucky I didn't text her instead. So good afternoon, good morning, whatever time of day it is today. I get kind of lost this time of year. But, yeah, it's when Amy asked me to do this topic and tell me a little bit more about the program, I think it's a great program. I think you can never have enough education on how to, help yourself financially, again, to reach those healthy heights and things like that. So, I mean, it's a great program. So, let's see. All right, so we'll start out just kind of getting everybody an update on the 16 taxes. Your standard tax deduction, married, filing joint, is $12,600. Surviving spouses also get that deduction in the year that your spouse passed away. Married filing separate and single filers, the standard deduction is $6,300, and you get a $9,300 deduction, standard tax deduction for the head of household. Head of household would be individuals who are divorced, who have dependents living at home, maybe grandmothers who are taking care of grandkids and things like that. You would qualify for a head of household deduction if you've got someone living in your home more than half the year that you're offering support for. Senior tax deduction, for those of you that maybe are 65 or older, you get a higher standard deduction than what we just talked about. You get a step up in that for 65 and older taxpayers. Personal exemptions for 2016. Personal exemption is $4,050 for each personal exemption, as well as each dependent that's claimed on your personal tax return. This is up from $4,000 in 2015. This typically goes up incrementally each year with changes in the tax code. There are some income limits on the deduction. When you get your adjusted gross income gets high enough, some of those exemptions start to get limited. Usually that is $250,000 and above adjusted gross income. You start to get limited there. Medical and dental expenses. This ought to be one of you guys' favorite slides here. These are deductible for your spouse and your dependents. The caveat on that is, though, they're only deductible after you reach 10% of your adjusted gross income. So just to make my math easy, let's say your adjusted gross income is $50,000. You would have to have $50,001 of medical expenses to get $1 of deduction. So it's written in such a way, the code's written in such a way with the medical expenses, you typically don't get much of a deduction in itemizing those deductions unless you've had, maybe a surgery or some catastrophic health illnesses during the year. Maybe you're on a lot of expensive medication and things like that. You'll be able to get that deduction because, again, you have to exceed 10% of your adjusted gross income. If you're 65 or older, that caveat goes down from 10% to 7.5%. Over 7.5% AGI, you can deduct your medical expenses at that point. Tax preparation fees is another one that a lot of times gets forgotten as far as the deduction. Your tax preparation fees are deductible. Now, whether that's going out and buying a copy of TurboTax software, that's deductible. Whether it's coming to a CPA and paying us to do your return, all those are deductible subject to 2% of your AGI. So just like the medical expenses, the tax preparation fees would have to be 2% of your adjusted gross income to be able to get a deduction. And feel free to stop me at any point. I should have said that along. Feel free to stop me at any point if you've got any questions. I'll be glad to answer anything that I can. Home renovation expenses. Typically, these are not deductible unless they're for medical purposes. Maybe you have to put in a handicap wheelchair accessible ramp or lowering cabinets for maybe yourself or a dependent that's in a wheelchair. Those would be deductible items. Anything, the only exception to that rule is any renovations that increase the value of your home, you can't claim those as a deduction. Those would basically be added to what we call the basis in your home. If you ever sell your home, and we'll talk about that in a little bit, that would go toward your increase in your cost basis of your home originally. Job search expenses. This is another good one that's a lot of times forgotten about. Those expenses you incur in searching for a new job, as long as it's in the same line of work as your most recent job, are deductible. Some examples of those expenses are transportation, 54 cents a mile, going to and from interviews, things like that, parking tolls, cab fees, preparing, printing, and mailing out your resume. That's also another deduction that a lot of times gets left out in your job searching expenses. Any fees you might pay to a headhunter type organization or something like that, a hiring agency or something that's helping you get into the door, get into those resume, helping you with the resume or getting you interviews, those are going to be deductible items as well. Of course, then employment agency fees along with that. Hobby expenses. Typically, losses from hobbies are not deductible by the IRS. The IRS has a little-known rule. If I decide today that I'm going to go in business for myself as a tax preparer, if I don't show at least $1 of profit, taxable income, in one of the first 5 years, the IRS deems me to be doing this as a hobby, and so I cannot deduct those losses going forward. So we have a lot of clients that have home-based businesses and things like that, and so we always caution them on that. If it's usually in your first year of a startup, you're going to have a loss, but sometime in the next 4 years, you need to show some sort of profit. You need to be working toward that profit so that those losses don't get disallowed by the IRS. Because I have had clients on an audit where they come back and deem that business to be a hobby and go back and amend prior year's tax returns to basically take away those losses that have been claimed in previous years. That being said, though, as a hobby, some ordinary expenses incurred can be deducted. Again, this would be things like mileage, if postage, mail outs, things like that. If it's still a hobby, those things can be deductible as an itemized deduction. Again, those fall into this 2% adjusted gross income line. So they're going to have to be fairly significant for you to actually get any kind of deduction out of those. State and local sales tax. Obviously, yes, ma'am.
Okay, so a lot of people will do things on the side like Mary Kay or sell interior decorating or supplements or things like that. What is the norm in handling that kind of business?
Okay.
Do they just kind of leave it completely off of their taxes?
No, that would be, again, if your intention in entering into something like that in a home-based business is to make a profit, then you would file what we call a Schedule C on your personal tax return. What that is, that's a recap of the income earned less any expenses you've incurred in running that business, trying to earn a profit. So that would be a deductible. Where the IRS is going to come in is that Schedule C shows losses continue year after year after year. If you were to get audited, they could deem that to be a hobby and disallow those prior losses that were taken. All right, state and local sales tax. Obviously, we're lucky here in the state of Tennessee. We don't have a state income tax, so that's a great thing. Although we do have sales tax, and so one of the other itemized deductions that a lot of times is forgotten about is you are allowed to take the IRS. The IRS does it one of two ways. You're allowed to take sales tax off of your tax return as an itemized deduction. You can use the IRS tax table, which basically says if your adjusted gross income is at a certain level, this is the amount of sales tax we deem you to have been paid on an annual basis. You can take that as deduction. You can keep up with your actual sales tax expenses all year long if you want to and take the actual deduction. Most of our clients don't do that just because it's obviously very time consuming. So they use the table. Now, that being said, you can use the table but also deduct sales tax for any large items that you bought in the current year. For instance, vehicles. Any vehicle you buy is going to have roughly anywhere from $1,500 to $3,000 typically worth of sales tax and fees on that. You can take the sales tax table deduction as well as the large item purchases as well on that. State, local, and foreign taxes, again, if you're paying any state and local property taxes, real estate taxes, those are deductible. If you're paying any foreign real estate taxes or foreign income taxes, we typically don't see that a lot in Tennessee, but you know, if you're bordering Canada, for instance, things like that, or doing any business in Canada, they will charge a foreign sales tax that you can deduct on your personal tax return. State balance due, again, if you were paying taxes in another state, you can take a federal deduction for that amount of tax as well. Jury duty. So excited to go to jury duty. Said no one ever, right? That being said, though, anybody know that you actually get paid to go to jury duty? Anybody actually ever get excited about that? No. That being said, you actually can take that as a deduction if that jury duty is paid to your employer because they're still paying you while you're at jury duty. So let's say you're a salaried employee, you take the next week off to sit in jury duty, you're still going to get your salary. The court's going to pay your employer for that jury duty. They're basically, if they add that to your income, you're allowed to take that as a deduction. Because that's not really. Now, if your employer says, no, you know what, you're on your own, we're not paying you for this week of jury duty, then you would report the jury duty as income. But if your employer continues to pay you, you're allowed to take the jury duty deduction. Volunteer work donations. Any work related to any expenses incurred with volunteer work are going to be deductible. Your mileage, for instance, is going to be at a rate of 14 cents per mile that you're allowed to deduct for charitable purposes. Cost of purchasing, maintaining uniforms. You're volunteering at one of the local nonprofits, and there's a certain attire that you have to wear. You can deduct the expense of buying that attire to work in the volunteer as well. That's another deduction you're allowed to take. Bad debt deduction. This is one that's forgotten about a lot. If you loan someone personal money and they sign an agreement with you to pay it back, this can't just be me, hey, Amy, will you loan me $20 today? If I borrow a significant amount of money to the point that she requires me to sign a note, if you will, and I default on that, she gets a bad debt deduction for that. So that's one that a lot of times, that's one that's forgotten about because you think, well, I've lost the money. They're not going to pay me back. It's just a loss. You can actually take that as another itemized deduction. Moving expenses. So we talked earlier about job search expenses and things like that being deductible. Moving expenses are also deductible provided you meet the IRS distance and time tests after relocating. Qualified expenses, cost of moving your belongings, renting the U-Haul, hiring a moving company, things like that. Mileage traveling to your new home, that's at 19 cents a mile, as opposed to the 14 cents for volunteerism. You get 19 cents a mile to actually move. Cost of lodging for yourself and other household members or dependents. This doesn't include meals. You don't get a deduction for the meals you incur while moving, but you do get a cost for lodging, staying in a hotel, things like that as well. The IRS distance and time tests, basically if you're moving 150 miles or further away in your job or for a new job, then you can deduct those moving expenses. Yes, sir.
All these that you're going over now, still the miscellaneous 2%.
These are, some of these are the 2% itemized. All of these so far are itemized deductions. So yes, you still take these if you're allowed to itemize versus that standard deduction. So basically, as we talked about earlier, the first slide was a standard deduction. If you have itemized expenses over that standard deduction, you're allowed to take the greater of the two. So these would be additional itemized expenses. Mortgage insurance premiums. This is another itemized deduction as well, like your real estate taxes, your mortgage insurance premiums. Those are tax deductible really through the end of 16. On 1/1/17, that provision for mortgage insurance premiums expired. Now, there's some talk in Congress and things that may be extended. Does everybody know what I mean when I talk about mortgage insurance premiums? Basically, that's, if you've got less than 20% equity in a home, you're required to take out mortgage insurance, when you buy your house. You're paying that premium every month as a part of your monthly loan payment. So you're allowed a deduction for that mortgage, because basically when you're making your payment, you're paying mortgage interest and you're paying the mortgage insurance premium. Both. You're allowed a deduction for both of those. Typically, what we try to do with our clients is when we see mortgage insurance premiums recorded on a mortgage statement for tax purposes, we'll sit down and talk to our clients. And is it a situation where you're now own more than 20% equity in your house and you can cancel that mortgage insurance? The mortgage company won't do that for you. If you get over 20% equity, you have to call them and say, hey, this is the situation. I've got 20% equity. I need to cancel my mortgage insurance premium. They will verify that. They'll pull up property tax data, property tax records to make sure look what your current house would appraise for to make sure you've got that 20% equity. Mortgage interest deduction. Interest paid on loans of $1 million or less. If you're married filing separate, it's $500,000 or less. On loans $500,000 or less is deductible for mortgage interest. Points, prepaid interest, same thing as the mortgage insurance. Those items are deductible as well as an itemized deduction. Typically, note here, if you can deduct all the interest on your mortgage, you can also deduct the points. So the hierarchy of deductions is, from a mortgage standpoint, is mortgage interest first, mortgage points next, and then your mortgage insurance premiums is the third tier. So you may or may not get to deduct all your premiums based on your income level. Appraisal fees, another missed deduction. This is another one that's the 2% of AGI deduction. Appraisal fees in buying a house are not deductible. But if you were to get it reappraised for some reason, those deductions are available. If the property was donated, say you were going to donate, you inherited a house from maybe your grandparents, and you want to donate that to a local charity or church, you go and get the house appraised to figure out what that charitable donation deduction is. That appraisal fee is going to be deductible as well. Cash donations. Obviously, at the end of the year, you get a lot of pushes from a lot of the nonprofits, churches, and things like that. Hey, donate before year end, before year end. Most of us do a good job of keeping up with those. What we forget about, though, is those miscellaneous, maybe, the Relay for Life payroll deductions, or, I gave $50 to, the Boy Scouts, or because somebody come and knocked on the door and asked for a donation. The key on that is all the cash donations are deductible as long as you've got a written record. So what I tell everybody on that is that's why most of your churches use the envelope system, right? So they can keep up and give you a statement a year in. If you just put cash in the collection plate with no proof, you can't take a deduction for that. So what we always recommend is write a check or use the envelope system, really for any, not only church, but any of your nonprofits. Write a check so that you've got substantiation for that deduction, and try to keep up with those, through the year as best you can. Non-cash donations. Basically, on the non-cash donations, this is things like household items, clothing. We mentioned house a few minutes ago. You get a donation deduction for the fair market value of those items. So I go and donate, 10 suits to Goodwill. What's the fair value of those suits? Not what I paid for them, but what's the value today? That's your deduction, typically, on that. In most of your larger nonprofits, they have a way through their website or through a thrift catalog to give you a value for you to determine what your tax deduction is going to be on that. You can get a deduction for donating your car as well, as long as it's to a 501c3 charity. Fees to collect interest and dividends. So these are things like your brokerage accounts, your investment accounts, fees and things to collect that interest, maybe investment advisor fees and things like that. Those are all deductible items as well, subject to the 2% of AGI. That's one that's missed a lot. Fees paid to manage your investments. So some of the examples, investment counseling, custodial fees paid outside of the account. Most of our, I see Brad in the back of the room, most of your investment advisors are going to take that fee out on the statement. I don't see very often where you're paying that out of pocket, to your broker. But if you had something like that, that would be a deductible item as well. Software, online services used to manage the investments. If you're doing an E-Trade account or something like that, any fees they would charge you would be deductible as well. Legal fees, again, subject to the 2% rule. If they're related to doing or keeping your job, if it's related to collecting taxable alimony or dealing with tax advice, those would be deductible. Now, any other legal fees that you incur in a divorce situation, for instance, would not be deductible. If you are suing your neighbor because he put his new fence a foot into your backyard, that's not a deductible item. It's got to be for these very specific three specific opportunities. Safe deposit box rental fees. Again, this is one that's subject to the 2% rule. Basically, your $30, your $35, your $50 annual safety deposit box rental. That, again, a lot of times you just pay it. You forget that as a deduction. Gambling losses. I won't ask if anybody likes to gamble in here. I won't ask for a show of hands. Your losses are deductible up to the amount of your winnings. So I go to Tunica and I've gone all year and I've lost $10,000, and I go this weekend and I hit it big and I win 15. My $10,000 in losses are deductible. If I go and win 5, I get $5,000 worth of losses that are deductible. Now, the only thing on that is kind of a caution. Be prepared to show proof of your losses on that. That's a big one that the IRS likes to send you. When they see you claim gambling losses, you typically will get a notice from the IRS saying, hey, we want you to mail us proof of the losses that you took on your tax return. Casualty, disaster, and theft losses. This is another one that's a deductible item. basically losses related to home, any household items, vehicles, that these are losses not covered by insurance. So, this would be something like, and we saw this a lot, with the last tornado here in town. There were a lot of houses that were underinsured. And so the difference in what your loss was in the house versus what the insurance reimburses you is a deductible item for tax purposes. Work uniforms. If your employer requires you to wear a particular uniform that they don't provide, you can take a tax deduction for that as well. So, a lot of your nurses and things wear scrubs. That's going to be a deductible item for you guys because that's a required part of your employment to do that. Typically, those aren't provided. So, anything like that, military uniform. I've got some clients that are in the National Guard. They're required to wear a certain uniform when they're in active duty and things like that. If they have to go out of pocket for any of those items, that they qualify as a deductible item as well. Union dues. Again, another one that's subject to 2% rule, but any union dues, any costs associated with being part of a union, initiation fees, any other related expenses are a deductible item as well. Business use of your car. This is one that gets forgotten a lot of times here. Basically, you're allowed either the greater of the standard mileage rate or your actual expenses in maintaining the car. Actual expenses would be gas, oil changes, tires, any repairs to the vehicle, things like that, or your mileage rate. For 2016, that mileage rate's 54 cents a mile for business use of your car. Now, the thing you've got to be able to do to take that deduction is you basically need to keep a mileage log of day of the week, the date, what purpose it was for, how many miles you drove. Now, the thing I caution you on that, commuting mileage does not count as business mileage. So what we tell a lot of our folks that are small business owners, maybe they do work from home, you've got a P.O. box set up, for instance, where you're collecting payments and things because you're working out of your house. The mileage from your house to the post office and back is not deductible. That's considered commuting, okay? Now, if I'm going from my house to the post office and then from the post office to my actual place of business because I've got a storefront somewhere, then again, house to post office is not deductible, but post office to my place of business is. That's not considered commuting. So one of the things we recommend with all our small business owners is find somewhere to stop and get your cup of coffee, stop by the post office before you go to your place of business. Because once you make that first stop, anywhere after that is considered a tax deductible item as far as mileage is concerned on that. So that's one that gets forgotten about quite a bit, and the IRS is starting to look more at mileage logs and things like that when they do audits and off-site audits, questioning some of the deductions on your return. They're going to want to see those mileage logs. Business travel expenses. Again, these would be unreimbursed business expenses, would be deductible. Transportation, baggage fees, lodging, 50% of meals. Yes, sir. Yes. Correct. Yeah, any kind of continuing education, professional society dues are a 2% itemized deduction as well. Yeah. All right, the business travel expenses is the same. Meals, 50% of meals, your lodging, laundry, business use of your cell phone. We see that a lot. Is another unreimbursed business expense. You just got to be careful. They can't be considered extravagant or lavish. You can't go out to, have a $500 meal for dinner with you and one client. That's considered a little lavish. But anything beyond that, you can take as a business deduction as well.
Let me ask you a question
Mhm.
on the business use of your car. We have multiple buildings scattered out throughout Jackson and even West Tennessee. If the hospital is your primary location,
Mhm.
and then you're traveling back and forth to these other locations, can you deduct that travel if you're not getting it reimbursed through here?
You can because it's unreimbursed. That's right. That's right. Yeah, if it were if the hospital were reimbursing you, then that would show up on your W-2 as additional wages. So yeah, but yeah, basically your home to if the hospital is where your main office is, let's say, home to the hospital would not be deductible. Traveling to any other of the off-site facilities after that is be deductible mileage. Yes, sir.
Sort of relates to business travel. If you were traveling for continuing education purposes, does that fall into the same kind of ideas as
It would.
doing professional things?
Yes, as long as it were not reimbursed by your employer, it would be considered a tax deductible item.
Be one of those things that necessarily you need to watch out for point A to point B.
Correct. Exactly. So you go to continuing education in Nashville, leave your house in Jackson and stop somewhere first, and then that's when you start your odometer. And I know that kind of sounds, silly, but I've had that conversation with many an IRS agent over the years, and as long as we could always prove that our client stopped somewhere first and started counting mileage after that, then it's never been an issue. If you can't prove that, then I've had mileage cut as much as 50%. For commuting. Penalty for early withdrawal savings. So most of the things we talked about so far were itemized deductions. Those are items that you would be able to take if your itemized deduction total is higher than your standard deduction. The next set of items are what we're going to call, front page, page one type deductions. The first one of those being penalty for early withdrawal of savings. You've got money in a CD, you have to cash the CD out early, you have to pay an early withdrawal penalty fee. That's going to be a page one deductible item to do that. Home sale. We talked about sell homes a little bit earlier. This was instituted several years ago by the IRS, and it looks like this is basically going to be around with us forever, which is a good thing. You can married, filing joint. You can make up to $500,000 profit, and single or married, filing separate $250,000 profit on the sale of your home, and it's tax free. Now, to qualify as a tax-free home sale, you have to have lived in that home for 2 of the last 5 years prior to the sale. Yes, sir.
Do you also still have to move into like another primary? I think that was a rule, like you had to put the money in a new home.
No, that went away. That went away. So you don't have to. There's no reinvestment caveat anymore. As long as it's considered your personal residence, then you're good. Self-employed health insurance is another one that's a page one deduction. If you're considered self-employed, if you've got that Schedule C business we talked about earlier, and you're paying health insurance premiums out of your own pocket, that's a tax deductible item as well, provided you have taxable income from that business. So if I've got a Schedule C business out of my home, and I have a loss for the year, I can't deduct any of my insurance premiums. I have to show some amount of income to be able to deduct the self-employed health insurance deduction. Otherwise, the health insurance I've paid out of pocket goes to Schedule A itemized deductions, subject to our 10% of adjusted gross income rule. All right, so the health insurance would be medical and dental insurance, as well as qualified long-term care. Also qualifies as self-employed, and that's a change that was implemented. The long-term care was implemented in 2015. So that's a fairly recent change. For a long time, it was just purely health and health only. IRA losses. You typically don't see that very often, Brad. I hope we don't ever see it again. But in those rare instances where your IRA loses money, and this isn't losing money as far as the investments in my account, went down because the market took a hit. This would be the best example that I've seen on this and come up with is I took my IRA and I invested, for instance, in a real estate investment trust, for instance, and that real estate investment trust went broke and just walked away. My IRA, basically that $10,000 investment that I had is now worth zero. I would be able to take that as a deduction provided I could show that investment truly is worthless, that I took a substantial hit that I have no way of ever getting back. Like I said, this is not ups and downs in the stock market. This is truly, hey, I made a significantly bad investment with my IRA that I've lost money on, and I have no chance of getting it back. Alimony. Alimony paid as part of a divorce or separate maintenance agreement is deductible. It's reportable as income to the spouse receiving or ex-spouse receiving the alimony. Qualifies as alimony if you and your spouse did not file jointly. If you paid with cash, check, or money order, it can't be a property transfer. It's got to be a cash transaction. Payment went to your spouse or former spouse. You're legally separated and don't live in the same household as your former spouse, and your payment is not qualified under the divorce agreement as child support. So child support is not deductible. Alimony is. Health savings account contributions. You can claim a deduction for contributions that you made to your HSA or that someone other than your employer made to your HSA. You can't deduct the employer paid contribution, but if you're taking out a contribution of your own, that is a tax deductible item. Dependent care flexible spending accounts works the same way. You can contribute a maximum of $5,000 in your FSA every year, which is not taxed. Basically, the FSA is a pre-tax item. So, it's reducing your taxable income that gets reported on your W-2. Like I said, so you can basically shelter $5,000 of taxable income in an FSA that you're not paying income tax on. So it's a really good tool to use in your tax planning. IRA contributions, Roth contributions are not deductible, but traditional IRA contributions are. The limit for a traditional IRA for 2016 is $5,500 or $6,500 if you're 50 or older, and what we call the catch-up provision for those that are 50 or older. They're allowed to make an additional contribution and still have that be a deductible item. That's as long as you or your spouse, you each can contribute $5,500 each, as long as you're not in an employer-based retirement account. So if you're not a member, if your employer doesn't provide a 401k, your only means of retirement is an IRA, you can make that contribution and take that as a deduction. 401k contributions. Again, works just like the FSA. Typically, your 401k contributions are pre-tax, so you can shelter typically up to 15% of your income, your gross wages, in a 401k account. So which can significantly decrease your tax bill. Educator expenses. This is another one that's been around for a while. If you're a teacher, you're allowed a deduction of $250 on an annual basis as long as you're a K through 12 teacher and you worked at least 900 hours in the school. You can take that $250 deduction. If both husband and wife are educators, you can deduct $250 each, so you get a maximum deduction of $500. Student loan interest deduction. This is another one that's a page 1 deduction. You get the lesser of $2,500 or the amount actually paid is qualifying student loan interest in 2016. You can't take the deduction if you do a married filing separate return, or if your spouse is listed as dependent on someone else's return. You have to be able to claim yourself and or your spouse to be able to get that student loan interest deduction. Other educational expenses, and this has been extended through the end of 17. You can take up to $2,500 per student for your 4 years of post-secondary education. This is under the American Opportunity Tax Credit is the $2,500. Now we've got another one that's $4,000 in the tuition and fees deduction for 2016. Again, this is a deduction whether you itemize or not. Basically, you're allowed to take the greater of the two on that. You can't take them both, but you're allowed to take the greater of the two on that. Again, you don't qualify for the deduction if you're doing a married filing separate return or if another person can claim you as a dependent. Where we run in this to a lot is with taxpayers who have, college-age kids who are still trying to decide are they a dependent or are they not. Well, if I let my son, because he's got earned income, but he's still in college, if I let him file his own tax return and claim himself, I don't get the tuition and fees deduction or the American Opportunity Tax Credit deduction. He does. Now, this is all based on income, your taxable income. So what happens a lot of time is that student doesn't have enough taxable income to actually get a whole lot of benefit out of the education deductions. So what we'll typically do is we'll keep that student on the parent's tax return as a dependent. They get the deduction for the tuition and fees. Typically, they're paying it anyway. So they get the deduction. The student typically still doesn't have to pay any income tax because typically their federal withholding more than takes care of their tax liability anyway. So very rarely do you see an actual student take the tuition and fees deduction. Usually we keep that on the parent's return for as long as we can. Business use of your home. So we talked about our home-based businesses earlier. So if you have a home-based business, you're allowed to take a percentage of your household expenses off as business deduction. The way this typically works is it has to be a room in your house that's used solely for business. So in other words, I can't take a spare bedroom that I've still got a bed in and set up my home office and put a computer in there and call that my office. It's got to truly be an office. So I've got to take the bed out, put it in the closet, whatever, to be able to use this as a business use of home deduction. The way the deduction works is you take the square footage of the room that you're using as your home office divided by the total heated square footage of your house. That percentage, let's say it's 10%. That percentage is what you get as a business use deduction for various household expenses. Those household expenses are mortgage interest, insurance premiums, real estate taxes, home insurance, any major repairs you have on the house. If you've got an alarm system, your security system fees on the house would be considered a business use of home deduction as well. If you have a telephone line run specifically for that home-based business that's separate from your normal landline, then that's 100%. You get to deduct 100% of that telephone line expense as well on that. So again, especially those of you that have home-based businesses, this is one that often gets left behind that can really be a great deduction and really save you some tax when you figure all the things that you're really paying to upgrade your home. Now, things like getting the grass cut doesn't qualify. That's not considered repair. That's just normal routine maintenance. That doesn't qualify for the deduction. But if I've got to put a new roof on my house, the amount I pay outside of insurance does count as a repair and would count for this deduction. We're getting down to the end here. The earned income tax credit. This is one basically for those individuals who have taxable income ranging from $510 to $6,318 are eligible to take the earned income credit. That varies based on how many personal exemptions you take, single, married, filing joint, how many dependents you have. All that's going to factor into how much of an earned income tax credit that you're allowed to take as well. Typically, there's some additional things you have to provide your taxpayer or your tax preparer if you're to take the earned income tax credit, which can be a huge savings for you. But this year, the IRS implemented some due diligence requirements on us as preparers. So we've got to ask a few more questions. We've got to get documentation as far as, are the dependents that you're claiming, are they truly living in the house? So maybe we need typically a record of a school record showing the address of the kids, things like that, to be able to claim those dependents, to be able to qualify for the earned income tax credit. Any questions? I know I went by that somewhat quickly, just trying to make use of everybody's time as best I could. But does anybody have any other questions? I know we had a few along the way, but if there's anything that I didn't cover, maybe you have a burning question about, or anything I did cover, I'll be glad to answer any questions. Yes, sir.